Our next presenter of the day, Mr. Ken Shilson, President, Founder of NABD, National Alliance of Buy Here, Pay Here Dealers. I'm sure you know and have heard of Ken before, maybe even been to Vegas and been to one of his conventions. Subprime auto finance is booming, and Ken is going to talk about how you get your share. Ken?
Well, thank you very, very much, Paul. It's a pleasure to be back here. And let me start by saying that GIADA is one of the best dealer associations in the United States for two reasons: the leadership and all of you. Give yourself a big hand. All right, whether you're retail, whether you're buy here, pay here, whatever segment of the automotive finance business that you're in, you know how competitive it's been. And there's absolutely a tremendous challenge to capture the best customers. Everybody's fighting for them. And what I want to talk about today is who's winning, who's losing, where's the competition coming from, where's the money coming from, and what's going to happen in the future. And the next thing I want to talk about is what the most successful operators in the United States are doing to compete successfully. So whether you're in retail or buy here, pay here, I think there'll be some things here that you might find kind of interesting. So let's get started by taking a look at the subprime auto finance industry, actually the auto finance industry in general, and then we're going to move into subprime auto finance. And I think it's important to understand the changes that are taking place in the marketplace so that you can kind of see where you fit and where the competition is coming from. And I'm going to use Experian data to talk about the market in general, and then I'm going to move into some of my own data and data from others. So if we look at this first graph, and if it's hard for some of you to see, let me hit the most important points. First of all, the auto finance business, all auto finance, grew by 8% in 2014. But most importantly, let me tell you the pace at which it's growing. In the first quarter of 2015, there was $134 billion worth of auto originations. $134 billion worth of auto originations. And in the fourth quarter, there was 133. So you can see that with pace like that, this is a huge market and a huge opportunity. Now, who's getting this market share? And again, this is new, used, this is everything. Banks have about a third of the market, and the second biggest segment of the market is the captives. That would be GMAC, Ford Motor Credit, Santander doing financing for Chrysler Credit. So those are your captives, and then credit unions are third, and finance companies are fourth. And we're going to talk about each segment and why they're picking up market share. This next slide, though, is very interesting. It shows who's gaining the biggest portion of the market. And if you look on the right-hand side, that blue bar, that tall blue bar, that's credit unions. Credit unions are being very, very aggressive in getting automotive finance business, and right behind them are finance companies. And I'm going to talk about why that is, because I think it's important to understand what's driving this kind of growth. If we look at the whole pie as of the first quarter of 2015, banks had a little over they had about 34% of the market share. And the second biggest were the captives. But over on the right-hand side, when you look at a year-over-year market share, you start to see who's dominating. Well, credit unions, you can see, are getting the biggest share, and then finance companies right behind it. But I'm going to show you that's going to be changing. That's going to already start to change. But look at that green bar, buy here, pay here. That's what you buy here, pay here dealers are feeling out there. You can see that to shift, the 6.6% drop in market share, which is about a third of the buy here, pay here market share, has been taken by credit unions and finance companies, and I'm going to show you why that is. So that's the pain that you're feeling, is the shift and the race for your best customers by finance companies and credit unions. So where is all the action? Where is the sweet spot in auto finance? It's in the subprime. And that's evidenced by this slide right here. The tallest bar is deep subprime, and that grew by 5% last year, and right behind it is the next bar over. That's the next tier up in subprime. So if you got deep subprime, which would be defined as credit scores below 540, and 540 to 620 is the next segment up. That's just pure subprime. But together, they comprise over a third of the finance market. And why is there a gravitation to subprime? Because that's where the money is. That's where the highest yields are. That's where the perception of where all the money is made, and that's where most of you are operating. Now, if we look at the used segment, which is what I'm sure all of you are interested in, the last two bars, the green and the purple bar, represent subprime and deep subprime. And 35% of all used originations are either subprime or deep subprime. Now, here is an important thing for you to understand. First of all, why are credit unions growing? First of all, they're not regulated by the CFPB. Most of the smaller credit unions have access to low-cost capital, and they don't face the same regulatory challenges that we have with the CFPB. So they can be very aggressive. I'm not saying they should be, but they can be very aggressive, and they certainly have been in the last 18 months. But the finance companies, which are the other principal competitors, have been getting their money off of Wall Street. They've been getting them from securitizations. And if you're not familiar with what a securitization is, perhaps you remember the mortgage crisis, where Wall Street was bundling up mortgages into pools and using them as collateral on bonds that they would sell in the open market to investors and raise hundreds of millions of dollars. And the difference between an auto securitization and a mortgage securitization is this. In the mortgage securitization industry, the underlying value of the real estate was projected to increase, and that was part of the return. But in an auto securitization, the vehicle is projected to depreciate. So it's a much more conservative approach, and that's why I don't think we're going to have a subprime auto finance crisis in this country. But I can tell you that there's been some very, very aggressive underwriting done by players that haven't had a lot of experience in this business, and they've raised huge sums of money. Now, I wanted to use the Go Financial deal as an example. I'm not criticizing Go Financial. I'm not saying it's a bad deal. I just want you to understand how they're competing for subprime and deep subprime customers. First of all, securitizations, as of the first quarter of 2015, totaled $36 billion, up from $13 billion in 2010. So you can see there's been a tremendous amount of capital that's been raised. People like Scopus, Exeter, Flagship, now Go Financial, all coming into the market. The Go Financial deal is projected to be about $180 million. And the credit grader, this is right off of Bloomberg News, this isn't my analysis of it, has indicated that the base losses in the Go Financial deal are projected to be 34 to 37%, which is higher than anything that Drive Time did. Drive Time's been a regular securitization, and Go at one time was part of Drive Time. Well, the point that I'm making here is that more than 30% of the borrowers in the Go Financial deal have no credit scores at all and are lower than 540 credit scores. So it's exactly the customers that the buy here, pay here dealers have been serving. Now, I'm not criticizing Go Financial. If you could raise $180 million at less than 10% interest, I'm sure all of you would do it too. But I'm just saying that when you're competing against that kind of capital, you can understand why they're capable of dominating in the marketplace. So the question you have to ask yourself is, are you going to swing it out with them? Are you going to try to put more vehicle on the road? Are you going to try to put millions and millions of dollars of capital on the street? It's something to think about as you go back and operate for the next 12 months. And as you can see by this slide, in the deep subprime, which is the gold, that the finance companies in the first quarter are after that deep subprime market because they perceive that there's the biggest return there and they have very low cost capital. You can see that the credit unions have slowed down, captive autos have slowed down, and banks have slowed down. So my assessment is that there's opportunity out there. And I say that because when we look at the right-hand side of this bar, while the gold bar continues to rise for, the purple continues to rise for credit unions, it's rising at a slower rate than finance companies are. So I think as the securitization money starts to slow down, those customers and those vehicles are going to start to come back into the buy here, pay here marketplace. So I wrote an article a few months ago. I said they didn't steal our best customers, they just rented them for a few months. So the reality is that I think there is really good opportunity out there for buy here, pay here dealers. And again, this slide indicates in the subprime industry, the buy here, pay here change was less than any of the other three sectors. So some of the competition is starting to slow down. Again, securitization money is going to dominate in the market for a while, but there's still plenty of opportunity out there. And you can see the opportunity is in the used business, which is evidenced by the green bars here, that finance companies and buy here, pay here dominate that lower risk segment. You understand how to underwrite that customer. You understand that you've got to match the right customer with the right vehicle. You understand how to manage risk. You understand how to collect the money. And those things over the long term are going to be very important. So here's what Judicious Advisors said. They're a firm based in the Northeast, very reputable investment research firm. And they follow the securitization market. What they say is that what's happened is that with the shortage of vehicles from 2008 to 2010, we saw a rise in the price of used vehicles and the price of vehicles in general. And you feel that at the auction block. When you go out to the auction, you know you're paying more for vehicles with more mileage than you had before. It's kind of leveled off now. But the reality is that plus the recovery that we've seen in the economy have propped up earlier securitizations. But what Judicious Advisors said is that now that the used car values are starting to level out, that can all change. And that's where I think the opportunity is, that these newer issuers who don't have experience in this market, how to collect it like you do, how to match the right vehicles and the right customers, is going to allow you to get those customers back if you do the right things, and also get those vehicles back at the auction block. So I think that's where the opportunity lies. Now, many of you as used car dealers call and say, hey, I sold this many this month, and you judge your success by how many vehicles that you sell. And I understand you've got to sell it to make profit, but I suggest to you that where the money is really made is keeping it sold. And that's true whether you're retail or you're buy here, pay here. Again, you ought to strive to keep those vehicles sold and collect the money from the customers if you're in the buy here, pay here business. Well, how do you do that? And that's why I wanted to share with you what I see the most successful operators doing. And in doing that, I've analyzed over 1.7 million loans. I have over $15 billion worth of analysis in my database. And the important thing is that I want to share that information with you today so that you can see what the more successful operators are doing, and you can make a decision about whether you want to integrate some of these things into your own business. And the first thing I want to say is benchmarks. I think benchmarks are very important, and I want to emphasize that if you have not gotten a copy of the NIADA Used Car Industry Report, you ought to put that on your to-do list. If you're an NIADA member, you can get that free of charge, and Paul probably can assist you in getting that. If you can't, just let me know and I'll help you get it. It has a wealth of information. It'll be helpful to you. It talks about all segments of the used car market. It's free. If you're in the buy here, pay here business and you want to compare your results against your peers for the last 18 years, I've done benchmarks for the industry, and they're published on my website at subanalytics.com. They're all free. You can go on there. You can download those free of charge. You can then compare your results against your peers to see how you're doing. They've got financial results in there. They've got operating information. They've got trend analysis. Quite an extensive reporting package. So let's talk about what successful operators are doing. The first thing they're doing is they're managing credit risk successfully. Well, that's easy to say, but how do you do that? Well, you're taking one of the most important steps today by coming here and getting education, because knowing what's going on and being able to network with other dealers like you're doing here and reading the automotive publications is a key to understanding what's going on. So three of the keys to managing risk in your business and being successful: education, networking, and reading. And those three things all of you can do, and they don't necessarily cost you a lot of money to do them, but they cost you a lot of money if you don't do them. Now, the next thing is you have to maintain financial flexibility. I think it's easy if you're a buy here, pay here dealer to look at the size of your portfolio and say, hey, I've got more receivables than somebody else does, and that's fine. It's nice to have a good, big portfolio if that's what you're striving for, but it's also important to control debt and build equity in your business, because it's what you keep that counts the most. So operators call me and say, well, Ken, what do you mean by too much debt? What's too much and what's too little, and so on and so forth. So I created this slide for you, and if you'll go back and you'll take your balance sheet and you'll add up all your liabilities and you'll compare that against your total assets, if your liabilities are more than 56% or more of your total assets, you're highly leveraged. If they're 45 to 55%, you're about average in the industry. And if there's 45% or less, then you have a low level of leverage. Now, if you're in that high leverage category, my suggestion to you is that you try to reduce your debt as quickly as you possibly can. We know that there's going to be new compliance issues coming down the road. The cost of operations are going up. So you need to have the flexibility to be able to adjust to those things. And the thing that I'd say to you is that if you have to sell a vehicle today to pay the bills tomorrow, you need to get out of that situation. You really need to do that. So controlling your leverage is very, very important, and building equity in your company is a key to success. And one of the most important ways to do that is not just to cut costs, but to have a cash-efficient business model which generates an appropriate return on your investment. And what do I mean by that? I was speaking to a group in New York a few years ago of 20 of the largest buy here, pay here operators in the nation. Nobody had less than 40 million in receivables. And I asked the question, what kind of return do you get in your portfolio? Nobody raised their hand. I said, well, okay, well, what kind of return do you expect in your portfolio? Nobody raised their hand. I said, geez, I wonder if I'm in the wrong room here. So I changed and I said, look, let's forget I'm talking about buy here, pay here today, and I'm talking about a real estate investment that I want you to make. Or maybe I'd like you to put $1 million into a stock investment. And I was asking you to put $1 million in, what's the first question you asked me? And everybody raised their hand and said, what kind of return could I expect to get if I invested $1 million? And that's my point. Why would you invest your life savings in a business, millions of dollars, without knowing what kind of return you're going to get? And you need to understand that there's a lot of different business models that are successful, but are they cash efficient? In other words, measure the cash that you're putting in to growing your portfolio versus the cash that you're getting back. That's the return on investment calculation. So I said, geez, you don't seem to know what that number is. And John Linehan, who's now in the Hall of Fame, Buy Here, Pay Here Hall of Fame, said, that's not a fair question, Ken. And I said, okay, John, why not? And he said, because you'd have to know what your losses are going to be. And that's exactly right. You have to know what your losses are going to be, and you do that by using metrics, which I'm going to talk about here in just a minute. And you have to make sure that the return on your investment is appropriate for the risk that you're taking. You have to match the right customers with the vehicles they can afford. That's not happening in all the securitizations today. Through all that money that Wall Street is throwing at these deals, I'm not convinced that there's a proper matching. The terms are too long, the underwriting is weaker, the credit quality of the customers is lower. So I'm not convinced that that's taking place in these securitizations, but it's something that you need to do. The definition of good underwriting is matching the customer with a vehicle they can afford. Don't set them up to fail. Don't set them up to fail. And remember, your salespeople are looking at it through their eyes as to how quickly they can get a commission, not necessarily the long-term performance of your paper. So you have to take an objective look and make sure that you're matching the right customer with a vehicle they can afford. Now, here's an interesting thing. What kind of customer are we dealing with today? See if this kind of matches the people you're dealing with every day. This is from the Federal Reserve. This is Federal Reserve information. First of all, 47% of American households spend all of their income, go into debt and their savings just to meet annual expenses. So I think you would agree that's a measure of their financial capacity. That's a measure of their capacity. If a middle-class household had to weather a period of joblessness without income, they'd exhaust their savings in 21 days. Again, financial capacity. Over the last 3 years, consumer expenses have risen a total of 6%, while earnings have been flat. That measures their ability to pay. 55.6% of U.S. consumers have subprime or near subprime credit scores. That's what Jennifer Reed was talking about today, credit history. And then 20% of all U.S. households routinely depend on alternative financial services just to pay their everyday bills. And again, that talks about their ability to pay. So I was in one of the most successful operators in the United States, Buy Here, Pay Here operators, and I said, do you have an underwriting system? He said, yes, we use the cash system. I said, the cash system? And he said, yeah, you know what cash is? I said, well, I think I do. At least I thought when I came in here. He said, no, from an underwriting sense. So here's what he showed me. He said, we use our experience, our technology, and our training to measure 4 things. We look at their capacity, we look at their ability to pay, we look at their stability, and we look at their credit history. And if you believe in acronyms, that's CASH, cash. And so as you put your underwriting systems together, think about the cash. Think about the cash. Now, avoid trial and error mistakes because they can cost you millions of dollars. For years, people said, hey, just give me the formula. What's the formula to success? Let me just plug it in. I don't need to learn all this other stuff. And I used to say there isn't one. And then I realized that I'd been wrong, that the real key to managing risk in this business is cash and deal. That's how much money you're putting on the street. That's how much you're putting at risk. So as you look at your business model, you have to understand your cash and deal. And mistakes today have never been more expensive. This is coming out of the benchmarks. Since 2010, in the Buy Here, Pay Here industry, we've seen ACV increase 39%. We've seen down payments decrease 19%. And as a result, cash and deal has gone up 53%. 53%. Now, I suggest to you, when you're dropping those down payments, that dropping your down payments is like dropping your pants. They'll both get you into trouble. So the reality is that dropping your down payments to get more business is not the way to go about it, because if you're paying more for the vehicle and you're not getting more down and your repayments are staying the same, you're extending the term out. And now we're out 43 months on average, and it's not 43 months that's the true term of the vehicle, because we all know in buy here, pay here that these customers have problems. You have to extend them, you have to modify, so the duration is usually 2 to 6 months longer. So now you're out to 49 months. So the reality is you have to think about the term, because time is your enemy. Time is your enemy. It's more time for the vehicle to break or the customer to have a financial problem. So the reality is that we have to look at all the components. We have to look at cash in deal. We have to look at down payment, repayment. We have to work hard to get those numbers up and shorten that term. You have to learn from your losses so you don't repeat them. I think some of the best entrepreneurs I've ever met are in the business, and I'm sure some of them are sitting right here in this room. But what I'm saying to you is you learn the most by looking at what's not working for you. And when you study your losses and you start looking at your losses, you start to understand what you need to do differently, what's working and what's not working, and it keeps you from repeating those mistakes. How important it is? Well, if you look at these numbers, bad debts are one of the biggest expenses in your income statement, whether you're doing a good job or not, and buy here, pay here. So controlling those losses and controlling that risk is a key to your success and profitability. And you do that by taking a look under your hood. When you go out to the auction, do you buy the first thing that comes down the lane? Do you take a look under the hood? Would you buy a vehicle without a mechanical check? Well, don't build a multi-million-dollar portfolio without looking under your hood as well and finding out what's really working and what's not. You have to maximize your recoveries. You have to maximize your recoveries, because losses are part of the business, and you have to take the appropriate action when customers don't pay. And you can see here that as of 2014, almost a third of all the write-offs were mitigated by recoveries. So whether you're in a state where you can garnish or you're not, you have to make sure that you're maximizing the recovery on the vehicle. And if they don't pay and you can garnish, you have to enforce your contractual rights. It's just part of the business. And you shouldn't be afraid to do that. If you're doing the right things, you should pursue recoveries. How important, the average recovery in 2014 was almost $2,700. So you can't afford to throw that money away. You have to work on recovering when your customers don't pay. Nobody rides for free. Nobody rides for free. Control costs and expenses through efficiencies achieved by implementing technology. I know that many of you, as you go into the exhibit hall tonight, are going to say, geez, it's tough out there, Ken, and I don't want to spend any money on technology. I don't want to implement any of that. That's your investment in the future. You have to make those investments to stay competitive. So technology is going to increase your efficiencies, and it's going to increase your ability to compete. And if you look at this slide, these are percentages of sales. You do a good job of controlling the cost of your vehicles. In other words, you make adjustments when the markets change, but operating expenses are going to be more difficult to control, because in an environment where we're losing some market share and sales are declining, it's going to be tougher to squeeze more from an operating efficiency standpoint, and that's where technology comes into play. And I invite you, when you look at those benchmarks from the Used Car Industry Report or download them off my website, I invite you to look at how those expense categories compare with your own numbers. There's a line-by-line item in your operating expenses. Are you spending more on advertising? How's your payroll expense? Those kinds of things. And you need to ask yourself, if you don't compare well, am I operating efficiently? Am I operating efficiently? Am I using technology where I need to control my operating expenses? You have to use metrics to monitor portfolio performance and adjust underwriting. And it's not a crime if you don't know what static pool is, what loss to liquidation is, what default rate is. But it is a crime if you don't start building that data, because that's what you're going to need to raise money in this business. That's what you're going to need to monitor your business in the future. And again, if you go on my SubAnalytics website, there's 2 videos that explain and illustrate what they are, so you'll be able to see in less than 10 minutes what that's all about and start building that data so that you can monitor your performance properly. Don't overpay your taxes. Don't overpay your taxes. I know that's easier said than done, but the first thing is, if you have a buy here, pay here operation and you're growing it and your portfolio is $500,000 or more in receivables and you're not using an RFC, God bless you. God bless you. Because why I'm saying that is somebody's got to overpay their taxes. I sure don't want to do it. So if you're not using an RFC, it's good that you're overpaying so that people like me don't have to. So you need to use an RFC to minimize your taxes. You have to communicate with your tax advisor. You have to do a projection, because good tax answers don't just happen, they're made. And you have to write off your bad debts when you know about them. You have to have a professional that understands your business. If you're teaching them everything and he's sending you a bill, that's not going to work. And finally, you have to keep good financial records. You have to. This is a financial business where you have to have financial discipline and know where you stand at all times. Not just your bank balance, but how you're really performing. And as somebody who generated financial statements for 30-some years, it's fool's gold. Because in buy here, pay here, you're booking all this paper profit, and it doesn't often turn into cash in some cases. So don't judge your success by looking at accrual basis financial statements. If your CPA doesn't know how to start an RFC, I have a kit that they can get and do it the right way. It's perfectly legal. I've written 3 audit guides for the IRS, and there's no problem using related finance company if you do it properly. The next thing I want to talk about is resolving customer complaints. Tom Hudson and Sean Peterson are going to talk about compliance after I get done, and I think it's so important today that you resolve customer complaints before they become a problem and the Attorney General is sitting in your general manager's desk chair. That's never a good thing. But more importantly, don't do it just because of compliance. Do it because we need to regain market share. And the best way to regain market share is to rebond with your customers. Those are the people that are going to do business with you. And through all this technology, we don't want to lose sight that we're dealing with consumers, we're dealing with people. So rebuild these relationships. And that starts with your collection operations. It starts with you keeping in touch with people and getting these customers back in our marketplace. They're not going to come back by themselves. You have to earn their business. And the advantage that you have is that when their vehicle breaks, you're going to work with them. You're going to fix it for them. And in these securitizations, when that car breaks, they're going to jerk it out from under them. They're not going to repair it for them. So the reality is that we know these customers need to have a financial partner in these deals during the life, and that's the role that you can play and keep those customer relationships and rebuild them again. You're going to find that that's going to help you from a regulatory standpoint, but it's also going to help you regain market share. Now, the next thing I want to talk about is a chief compliance officer. When you leave here and you reflect on all the things that you've learned today, you're going to get back to your operation and you're going to have 1,000 things to do. And compliance isn't going to be the first one on the list, I promise you that. You're going to say, yeah, I know I need to do that. Yeah, I know I need to get my paperwork reviewed. I know I should be making some of these disclosures. I should check some of these things. Well, the reality is that's never going to happen. That's never going to happen until you appoint a chief compliance officer. You've got to put somebody in your organization and make them responsible for helping you get compliant. And it shouldn't be you. You've got 1,000 other things to do. So the first step in compliance is appointing somebody in your organization to make it happen. And when you do that, you're going to have to give them the training and the resources that they need to get the job done. That's when it's going to happen. And it's going to make you a better operator. What the CFPB is doing right now, I don't necessarily agree with, and I'm sure you don't either. It's hard to understand some of the things that they're promulgating, but it doesn't matter. It is what it is. But the reality is that you can't afford these compliance mistakes to bring you down. And the byproducts of what's going to happen are two things that are positive. Number one, it's going to force you to operate with more attention to the consumer and to build those bonds and the relationships which the buy here, pay here business was founded on. So the reality is that's a good thing. That's a good thing that we're going to reconnect with our customers and work with them. But the second part of it is it's going to drive the bad apples out of the barrel. They're going to get detected. The CFPB is going to find them and they're going to place them out of business, and that's going to be good for all of us because the cheaters and the people that don't want to do the right thing are bringing us all down, and we're going to be judged by those people. So the reality is it's going to weed out the bad apples, and it's going to help us become more consumer conscious, which are two good things. But as you go back and you appoint a chief compliance officer, you need to document your underwriting and collection procedures. You need to have a complaint resolution system, and you just need to make sure you get your paperwork reviewed. Just because it comes out of the computer doesn't necessarily mean it's right. So those are 4 things, and those don't cost a lot of money. Those aren't going to cost you a lot of money to do those 4 things. And if you do those, you're on the trail to doing the right things, and it's going to help you both business-wise and compliance-wise. So I want to conclude with a couple of things. Buy here, pay here is so important to transportation in America. You, as entrepreneurs, provide transportation to millions and millions of Americans who otherwise wouldn't have it. And at some point, I believe our regulators are going to start to understand that if they put you out of business, that there's going to be a lot of people walking in this country, a lot of people that can't get back and forth to business. And you're great entrepreneurs. Some of the best business people I've ever met are in this business. You should be proud to be a buy here, pay here dealer. But in the future, we've got to work smarter while we're working harder. And we've got to change some things because the old ways just aren't working the way they used to. If you think about some of these things, if you want to know more about some of these things that I've talked about today, NABD is going to have a show in Orlando, November 3rd to the 5th. We're going to have a compliance university track, which Tom Hudson and many of the others, Sean Peterson, and several other top attorneys are going to be there. I think we're going to have some regulatory developments by then. You'll get a certificate. We'll also have a best operating practices panel. Some of you may, and I've, in appreciation for being here, I've given Paul John, and I have in my booth tonight in the exhibit hall, a coupon that will allow any member of GIADA to attend that show cheaper than anybody else. So the reality is that I want each of you who can make it and would like to be able to attend. Some of you are visual people, and we have a Buy Here, Pay Here boot camp in Charlotte, North Carolina, where you can see one of the best operations in the country, visit with all the people, get pay plans, procedures manual, compliance information from Tom Hudson. I have modeling projection software. So if you're a visual person and like to attend boot camps, we have that kind of training as well. I think that in education, there's 3 legs on the stool. The first is being a member of your state association like you're doing here. It's very important to understand what's going on in your state. Being a member of NIADA. That's very important because you have to know what's going on in the used car industry. But then you need the specialized training for whatever segment of the industry that you operate in, be it retail, like Joe Lascota was talking about, buy here, pay here. You've got to get that specialized training. So again, those are things that are going to help you avoid making million-dollar mistakes. So with that, I'd like to conclude. I hope that all of you will have a great remainder of 2015 and that 2016 will be your best year ever. But I encourage you to make it that way by not doing the same old things and expecting a different result. So thank you all for having me here today. God bless you. Thank you.